We had a fairly red day in the S&P yesterday, and today looks like it'll be more of the same with red right across the board in the pre-market. However, a lot of this, as we can see, is being driven by the extreme fear we are now seeing in the market. Investors do seem to be getting a little bit scared, and it wasn't that long ago that we were in fact sitting in neutral as well as greed. So let's take a look at the company that is under the radar today, Novo Nordisk, which is down more than 20%. Now this is what we call an extremely high quality company. We're going to run through why we believe it to now be severely undervalued, and also firstly understand what has really moved this down. So as we note here, they did have a disappointing trial result, and whilst we see it down 19%, at one point today it was down more than 24%, so has started to, although slightly, recover upwards. Now what is the main driver for this drop? Well, as we can see, they do make the very popular obesity drug. They have said their new drug has helped their patients reduce their weight by 22.7%. What were the analysts expecting? Well, 25%. And as we can see, that is what we would consider a fairly marginal difference, but ultimately it has been the main driver for pushing this company down significantly. Now, for those that don't know too much about the company, well, Novo Nordisk, they are a global healthcare company. They specialize in research, development, production of innovative treatments for diabetes, obesities, as well as other serious chronic diseases like rare bloods and endocrine disorders. Now, if we take a look at how they make money, the vast majority of it does come from diabetes, but we also have some in obesity care, as well as around 2 billion from this final segment in rare diseases. So is this justified, the drop? As we can see, when we zoom out, over the longer term, even though it will be down slightly, they have massively outperformed the S&P 500, and with the new price, as we see in the pre-market at $82, it will therefore give this a new 52-week low, the old one being 99. In terms of the yield, while it does sit at 1.4%, after the drop, we are anticipating that to move more towards the 2% mark, and the forward P that sits at 32, we would anticipate that to come down in the high 20s. We get a double buy signal from Seeking Alpha and Wall Street with a hold from Quant, and for those that just want to understand how their latest earnings were, well, it was fairly decent as the shares were up around 8%. We can in fact see they were pretty much in line with expectations, although their net profit, their bottom line, was a little bit higher than what the market was expecting, and they also narrowed their sales guidance, although very marginally, 23 to 27%, previously sitting at 22 to 28. One of the main key highlights being the sales of their obesity drug up 79% in comparison to the same quarter last year. Now, if we take a look at their earnings expectations for the next quarter, they're anticipating 24% growth on a year-on-year comparative, and over the last four, we do notice they have beaten 3 of the 4, giving them a 75% track record, and ultimately over the next full year, they're anticipating $3.85, which will in turn lower the forward P to 26.9, but as we said, we do anticipate this to go even lower after the market open. In terms of the company, we've already mentioned high quality, so let's take a look at their underlying metrics that support this analysis. We have a 99 very safe dividend score, the highest obtainable. We'll talk about these two metrics, but just over the last year, they have increased the dividend at a 52% rate. That is very strong. Again, we'll look at the historical data behind it, and the dividend safety score was just reaffirmed last month, where a dividend cut does look to be highly unlikely. Now, how did they perform in the last recession? So key metrics from the 07-09 great crash, they increased the dividend, they had plus 6% sales, which was above the S&P's negative 12, and they also outperformed the S&P negative 27% return, the S&P itself negative 55, and as we said, beautiful increase over the last 4 years, 18% over the last 5, and 21% on average year on year over the last 20, and we can see they are a dividend aristocrat with 25 plus years of consecutively increasing the dividend. Now we're going to get into the first valuation model here, but do bear in mind we're not looking at this in pure isolation, and we will run it through our own model, the DCF, towards the end. Now the blue tunnel does essentially tell us the expected fair price, the intrinsic value, and whilst right now we are seeing it at the lower end, this hasn't updated to reflect the $80 price, which will put this significantly lower, giving us that extreme undervaluation signal, and we'll also be able to show you that that will be reinforced when the market opens on dividend yield theory, as that tells us a company is undervalued when the current yield sits above the 5-year average. As we said, that will be towards the 2% mark, and the forward P as well, already sitting lower even before the drop. That tells us again undervaluation. One thing we would say, even when it does come down, it is still going to be trading at a premium to the healthcare sector overall. And as we always say, some companies do deserve to be trading at a premium. We believe Novo Nordisk is one of those, and again, we will show you in comparison to the sector median. So first underlying metric is the free cash flow. Earnings data, remember, is susceptible to manipulation by management through accounting. So we draw your attention to this, and we want below 60%. Main reason for that gives us faith management will be able to offer those very attractive double-digit increases, and over the longer term, pretty much straddled around that year-on-year, 52% anticipated over the next 12. So we should expect the continuation of these very large increases. Then we move to the free cash flow per share, where we want to see consistent increases over the longer term. We actually don't get far off that with NVO, in fact tripled over the last 10 years, and over the next 12 months, $20 expected, a very nice jump, showing us that there is no slowdown to the growth we have seen. In terms of the top line growth, well, sales, we want minimum 3 to 7%, 3 to 4 just to keep up in line with inflation. Last few years looking very strong at double digit, but even over the longer term, if we do in fact zoom out, we can see numerically they have grown their top line at a 3x rate, although we can see some periods where it has remained fairly flat, and the large bulk of the increase has just come since 2021. On top of the very nice double-digit dividend increases, we do get to see here shares outstanding reducing. Essentially, what the company is doing, returning excess cash to your pockets through those share buybacks. And as we can see, whilst not significant amounts year on year, we do like that consistency. And when we factor that in on top of those dividend increases, it is definitely a very nice bonus. In terms of the ROIC, well, 10% or more give us faith management are able to effectively allocate their capital. We're seeing some very high numbers. If you go and look at the last few videos on this channel, you won't notice many that get anywhere near this company. 72% in 2023, 67% on a trailing 12 month. Definitely something we would, as well as investors, consider very, very attractive. Then move on to the operating side. Now 12% as a bare minimum, we get that, but we also want to see operating efficiencies, essentially translating to margins increasing over the longer term. 39% in 2014, 46% on a trailing 12 month, again, very impressive. And the free cash flow, whilst not increasing, consistently in the 30s to high 20s, telling us this company is a free cash flow machine. The final metric, and maybe one of the most impressive, the net debt to EBITDA, remember referring to the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. The numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand, and correlates to dividend safety, which was 99, and balance sheet strength. This tells us over the trailing 12 month and over the next 12 months, it won't take Novo Nordisk even one day to pay off all of their debt net of cash on hand. A very, very strong balance sheet. And again, we will show you the information to support that. Now, we also want to let you know we have recently released our latest free weekly article covering 2 beaten down quality stocks that do look like massive buys. Now we drop one to your inbox every single Monday morning where we cover severely undervalued stocks for your attention, as well as what's gone on in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued stocks for the month of December. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab another spreadsheet with 29 stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So as we said, click below, you can sign up and start reading straight away. We can also see institutional ownership sitting around 11.5%. We have $3 billion worth of sales by these institutions over the last year, but we do see a little bit more buying over the same time frame at $4.2 billion, with a pretty much mixed in Q3, same number of buys, same number of sales, more buying than selling in Q2 as well as Q1. Overall though, institutions over the last year have been buying more than they have been selling, but as always, do your own due diligence, never copy what these institutions do. Now we have already shown you their top line revenue as we saw some very attractive growth over the longer term, with the majority of that increase just over the last 3 to 4 years. But we want to understand, what is the bottom line net income story to be told here? Does it follow suit? And the answer is pretty much yes, fairly consistent growths on a year-on-year basis, going from 4.3 billion in 2014 to 12.4 in the latest annual accounts. And we can see, based on the trailing 12 month, we are anticipating growth into December 2024. We also want to highlight the balance sheet. As we already said, it does look very strong. So a quick total cash versus total debt health check. Cash over the longer term, a little bit inconsistent, but has grown from around 2.6 billion in 2014 to 11.2. But as always, one number here in pure isolation isn't going to give anything away. So we compare it to their total debt numerically and directionally, and we can see it has been increasing, although very, very inconsistently over the last 117 million to sitting right now at 8.5 billion. But as we saw, their cash is superior, and as we mentioned and concluded, it wouldn't take them one day to pay off all of their debt net of cash on hand. Now we also want to just show you the cash this company does generate from operations, and similar to their revenue, has been increasing over the period. Right now it sits at just under 18 billion on a trailing 12 month. So what about the ratings? First one we are going to look at is the valuation, where they do get an F. Now remember, this is based on the old pre-crash numbers of 32.2. However, we still believe it will be higher than the sector median, and that will be reflective no matter which metric you use, and therefore tells us that Novo Nordisk, regardless of that drop that we saw today, is trading at a premium. Now remember the question we want answered, does it deserve a premium? Well look, on the growth grade they get an A-, year on year 26%, better than the sector at 7.5, revenue forward looking 22.5, better than the sector at 7.61, and we also notice their earnings per share over the next 3 to 5 years anticipated to grow at 15%, which is better than the sector at 10.5. So there is that argument right there for trading at a premium, but we can also back that up in terms of the profitability with an A+, gross margin 85%, sector 58%, bottom line margin 35%. The sector in fact is negative 4.2%, and the cash generated from operations 18 billion, the sector in fact burning through, losing money, negative 15 million. So quick recap for this part of the analysis: double buy from Seeking Alpha on Wall Street, hold from Quant, F on valuation, A- on growth with an A+ on profitability. So now let's take a look at two things before we jump into our own valuation model. First one, how do they compare against others in the pharma industry? So we want to look at total return, including dividends reinvested. Now over the last year, with their drop, they are down 16%, and that is the worst performing in the industry. When we expand to over the last 5 years, we can see they are still up 213%. And when we zoom out even further, over the last 10 years, whilst they aren't the best performing, we have Eli Lilly up more than 1,000%. They are still fairly strong, 367, and as we will come to show you, have still outperformed the S&P. Now remember, past performance isn't an indicator of the future. They could perform a lot better, they could perform also a lot worse. In terms of comparison against the S&P, well, over the last year, the S&P has outperformed, but over both the last 5 years, as we can clearly see here, as well as the last 10 years, Novo Nordisk has massively outperformed. Question is, can they continue with this outperformance? As always, we ask this question just to understand whether or not we should be thinking about a low-cost ETF that perhaps tracks the S&P, for example, VO. Now let's jump into our valuation model where we get $117. We've used the DCF model where we have the free cash flow year on year. Average growth at 11%. We've gone 14, marginally lower than analyst estimates as well as management. With a discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we get $117, deeming there to be 43% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Novo Nordisk or any others, but we'll show you for those that believe it should be lower at 12%, $102, 24% upside. At 16% for those that are a lot more bullish, $135, indicating 64%. Now we want to take the median rate of 14%. As always, we do apply an MOS where we use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $105, then we keep going till it's near the current trading price. And what we get to see with NVO in today's episode, you are right now getting a 30% MOS on what we deem to be a high quality company. But bear in mind, there are a lot of risk with the pharma industry, and some people will find that sufficient, others may not like the company at all, and some other people in fact might consider buying this company at a bit of a premium. So 30% margin of safety. Wall Street themselves very bullish. We saw the buy rating $148. They see upside of 80% over the next year, and they definitely believe this one to be a consideration in every portfolio. As always, give us your thoughts in the comments below. Are you buying, maybe holding, or in fact this has scared you off and you are looking to sell? Don't forget to sign up to the free weekly newsletter, grab those spreadsheets as well, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.